Greetings, folks. Welcome to the Liberty Call. It is Wednesday, August 31st, 2022. Hope everybody's having a fantastical day out there. Another ugly day in the markets. I feel like I keep saying this over and over again. We've had, how many days in a row is this? 1, 2, 3, 4 days in a row. And let's see, 4, 5, 6, 7 out of 9. So, definitely not excellent when it comes to the market right now. But again, not really surprising. I was expecting a dead cat bounce. I didn't think it'd go as long as it did. But hey, we're back on the downward trend. So be careful out there, folks. If it's your first time watching, please give me a big old like, share, subscribe. Slam that subscribe button. I would greatly appreciate it. Let's see here. Let's go ahead and jump into the markets for today. Let's see how they did. I mean, nothing terribly down. Most of domestically, we're down less than 1% across the major indices. The Dow Jones was down 0.88% or 280 points, closed at 31,510. S&P 500 down 0.78, closed at 39,54. NASDAQ down 0.56, closed at 11,816. And at some point during the day, all three of these were in the green. They did make a nice. Let's bring up the chart here and go to the. We can see here, this is the Dow Jones. Yeah, late morning, did cross over into positive territory. Started out the day in the green, and but after about, what time is that? About 12:20 Eastern time, it went below. Same with the S&P 500. You can see, started out in the green, went red, went back green, and did touch into positive territory after the 1 o'clock Eastern hour. And same thing with NASDAQ. It was kind of hugging the the midpoint all day, and then really started to falter here in the end of the day. So, all right, well, let's go ahead and check everything else out. The VIX was down 1.3% today, closed currently sitting at 2587. Canada was down 0.93, Brazil down 0.54, Mexico down 2.18%. Jumping across the Atlantic, Germany down 0.97, UK down 1.05, France down 1.37, Euro Stoxx was down 1.25, Netherlands was down 1.45, Spain down 1.17, Italy down 1.22, Switzerland only down 0.27, and Portugal down 0.42. Moving further east, Russia, the MOEX was up 4.05, and the RTSI was up 3.82. Moving to the Asian markets, Japan was down 0.37, Australia down 0.16, New Zealand down 0.17. In the Chinese markets, they were kind of split. The Shanghai down 0.78, SESC component down 1.29. China A50 was up 1.08%, DJ Shanghai down 0.62, and the Hang Seng basically flat at up 0.03, and the Taiwan weighted came in up 0.95%. So like I said, pretty ugly day in the markets, but certainly not the end of the world. Hopefully, by this point in the year, with everything that's been going on, you have things adjusted so that you're not going to get clobbered too badly if things do go the way I think. But again, that's just pure speculation based upon historical trends. But if you need some help with that, give me a call. I'll be happy to help you. All right, well, let's go ahead and jam through today's market recap and see what happened there. S&P 500 slips as rate hike fears persist. Again, I don't know why anyone is fearing rising interest rates. I've probably said this 100 times already in the last year plus. Interest rates have been obscenely low for more than a decade. And getting them back to a state of normalcy, we're going to go through some hiccups. Plus, the people who control interest rates right now, the Federal Reserve, kind of created this problem along with the people and the politicians in Washington with printing up so much money over the last 2.5 years. The 400 economists that work at the Fed, you'd think someone would have raised their hand and said, this is a bad idea. We probably shouldn't print $5 or $6 trillion, especially when the money supply was only like 15, 16 trillion at the time. So you increase it by 40%, you're going to have some problems down the road. So, all right, let's go ahead and read through this. The S&P 500 slipped Wednesday after struggling to hold early day gains as fears about aggressive Federal Reserve rate hikes continue to keep investors on the sidelines. Big tech traded mixed after retreating from session highs as rate hike fears persisted, pushing up Treasury yields and souring investor sentiment on growth sectors of the market. The U.S. 2-year, which is sensitive to Fed rate hikes, continued to flirt with 14-year highs. Cleveland Federal Reserve President Loretta Mester said Wednesday that the Fed would need to lift the, quote, Fed funds rate up somewhat above 4% by early next year and hold it there, end quote. Well, at least someone's talking about getting rates up above 4. I mean, it's the article we covered yesterday. I think they were saying about 3.5, 3.75, and that'd be fine. That's going to bring that high inflation way back down. So, and I know there's a lot of people who follow, economics and things like that who thought that Paul Volcker back in the early 80s was far too aggressive and was just jacking rates up like crazy. I was listening to a podcast earlier with, I believe his name's David Horowitz, and he's an investment guy. And, he wasn't a big fan of it. Granted, he was an adult living through that time. I was merely a child, so I have different views on it. So, all right, where were we? The recent remarks from the Fed members that followed Powell's hawkish commentary last week has pushed the odds of a 75 basis point rate hike at the September meeting to 70%, according to Investing.com's Fed Rate Monitor tool. Qualcomm fell more than 1% to weigh on semiconductor stocks after the chipmaker was reportedly sued by ARM Holdings for alleged licensing and trademark violations. Materials, meanwhile, were also under pressure as commodity prices slipped on fresh worries about the impact of lockdowns in China on global growth after key cities including Shenzhen, Guangzhou, and Dalian saw fresh COVID-19 outbreaks. Newmont Gold and CF Industries Holdings, Inc. fell more than 2%, while the Mosaic Company slipped nearly 5% after reporting a fall in potash sales for July. Energy added to its slump from a day earlier as oil prices fell as fears about the impact of a slowing global growth on the energy demand offset positive data showing weekly U.S. crude inventories unexpectedly fell last week. On the earnings front, HP fell 7% after reporting weaker than expected revenue as slowing PC sales weighed on performance. Chewy's Inc., or Chewy's, the pet company, warning of slowing pet products demand and softer guidance sent shares sliding more than 7%. In meme stock related news, Bed Bath & Beyond cratered nearly 21% after delivering a strategic update that includes plans to cut jobs, reduce its owned brands, and sell an undefined amount of stock to turn around its business. The latest wobble in the broader market has pushed stocks into, quote, moderately oversold territory, end quote, Janie Montgomery Scott said in a note, and paves the way for potential counter-trend rally efforts as early as this week. Really? You think there's going to be a massive uptrend based upon all the data and news that's coming out right now? I don't see it. But again, I'm just one guy. All right. Next up on the docket is U.S. private payroll growth slows in August. This comes from ADP. U.S. private payrolls increased moderately in August, according to the ADP National Employment Report, which likely exaggerates the slowdown in the labor market as government data continues to point to strong demand for workers in very tight conditions. Private employment rose by 132,000 jobs in August after increasing 268,000 in July, the ADP report showed on Wednesday. Quote, our data suggests a shift towards a more conservative pace of hiring, possibly as companies try to decipher the economy's conflicting signals, end quote, said Neela Richardson, chief economist at ADP. Quote, we could be at an inflection point from supercharged job gains to something more normal, end quote. Let's see here. Government data on Tuesday showed that there were 11.2 million jobs on the last business day of July, with 2 openings for every unemployed person. Despite the Federal Reserve's rapid pace of interest rate increases to quell inflation, there have been no widespread layoffs, with weekly jobless claims still at considerable considerably low levels. The ADP report was suspended for June and July while the company revamped the methodology for data after a poor record predicting the private payrolls count in the Labor Department's Bureau of Labor Statistics employment report. The ADP described the new report, now jointly developed with Stanford Digital Economy Lab, as, quote, an independent indicator and complementary to government data, end quote, and not considered a forecast of the BLS private payroll number. Historical data for the past 12 years has been benchmarked. Economists were skeptical that the new ADP report would be a reliable labor market indicator. The new report contains only one business cycle, where capital economists said limited the usefulness of the series' engaging turning points. Quote, the new series paints a markedly different picture of employment than both the official household and establishment surveys, end quote, said Michael Pierce, a senior U.S. economist at Capital Economics. Quote, for example, during the initial stages of the pandemic, the new ADP payroll measure fell by less than 7 million, approximately a third of the size of the decline on the official measures. The subsequent recovery in the ADP figures has been correspondingly weaker, end quote. ADP's Richardson said it was important to look at the overall trend, noting that the two surveys were capturing the labor market from different angles. In the BLS survey, Bureau of Labor Statistics, a person is counted as employed if they receive a paycheck during the week that includes the 12th day of the month. The ADP survey asks how many people were on the company's payroll during that period. Job gains last month were concentrated in the services sector, which added 110,000 positions. Employment in the goods producing industry increased by 23,000 jobs. The report was published ahead of the BLS's more comprehensive and closely watched employment report for August on Friday. According to a Reuters survey of economists, private payrolls likely increased by 300,000 jobs in August after rising 471,000 in July. With no employment gains in the government sector anticipated, that should leave overall non-farm payroll gains at 300,000. The economy created 528,000 jobs in July. Quote, I don't think the ADP numbers tells us too much about the upcoming jobs report on Friday, end quote, said Jeffrey Roach, chief economist, LPL Financial. However, both reports are supporting the same narrative. The labor market is slowing as businesses cut back on hiring during this uncertain period of slow growth and high inflation. So it looks like the government went in and, changed at least how the ADP report is being calculated. And, we'll see if it gets any better moving forward. But again, government reports are as good as the data that goes into it. Sometimes they're good, sometimes they're crap. All right. On the oil front, oil prices slump again, hit by demand concerns. Oil prices extended their slide on Wednesday, led lower by worries that the global economy would slow further with renewed restrictions to curb COVID-19 in China. I can't believe they're still freaking out about stuff like that. But hey, catching the sniffles is evidently really worrisome. Brent crude futures for October, due to expire on Wednesday, settled at 96.49, down $2.82 a barrel, or 2.8%. The most active November contract lost $2.20 to $95.64 a barrel. U.S. West Texas Intermediate crude futures ended down $2.09, or 2.3%, at $89.55 a barrel. Quote, the weakness coming out of China has played a significant role, end quote, in lowering prices, said Harry Altham, energy analyst at wherever. Quote, the fears of a demand destruction across the West as interest rates rise and inflation concerns grip Western economies, end quote. The market has been primarily concerned with inadequate supplies in the months following Russia's invasion of Ukraine, and as OPEC struggled to increase output, that drove near-term contracts to a sharp premium over later dated futures earlier this year. But that pattern has reversed somewhat, and as output has increased, both OPEC and the United States saw production hit its highest level since early days of the coronavirus pandemic, with OPEC's output hitting 29.6 million barrels per day in the most recent month, according to a Reuters survey, while the U.S. output rose to 11.82 million barrels per day in June. Both are at the highest level since April of 2020. Quote, the fear that there's a slowdown here and there's a potential for some additional supply increases coming down the pike is having some pressure on the market, end quote, said Mike Szabo. The Joint Technical Committee of the Organization of Petroleum Exporting Countries, or OPEC, and its allies, together called OPEC Plus, said it now sees an oil surplus this year of about 400,000 barrels per day, up 100,000 barrels per day from its forecast earlier a month earlier. Some OPEC Plus members have called for cuts. The group is next due to meet on September 5th amid weakening demand in Asia that spurred Saudi Arabia to lower its official selling price to that region. Quote, let's see. U.S. crude stocks fell by 3.3 million barrels, the U.S. Energy Information Administration said Wednesday, while gasoline stocks were down 1.2 million barrels. China's factory activity extended declines in August due to new COVID infections, the worst heat wave in decades, and an embattled property sector that weighed on production, suggesting the economy will struggle to sustain momentum. Parts of China's southern city, we already covered where they had their most recent COVID flare-ups. All right. So, like I've said all along, is that, we're really not going to see a lot of reduction in the inflation problem, at least, in consumer prices until energy prices subside. And, based upon the happenings in, in Europe right now with the, shortage of supply of oil and gas, to heat homes and businesses over the next, over the upcoming winter. I've been reading a lot of articles about, price shocks and supply disruptions and how that's going to affect a lot of the economy there in Europe. There's going to be that bleed over here into the U.S., I believe. So, until oil gets back and energy is back, to what we would consider normal, we're just going to have things be really, really expensive for the time being, at least in my opinion. All right, last up, some tax information. Are capital gains taxes on inherited property going to cost you a fortune? An inheritance is a windfall that can be absolutely helpful, help someone's financial situation, but it can make your taxes tricky. If you inherit property or assets as opposed to cash, you generally don't owe taxes until you sell those assets. These capital gains taxes are then calculated using what's known as a stepped-up cost basis. That means that you pay taxes only on appreciation that occurs after you inherit the property. A financial advisor could help you help ensure that you're filling out your returns correctly. Let's break down how capital gains are taxed on inherited property. There's three main types of taxes that cover inheritances. Inheritance taxes, which are these taxes that an heir pays on the value of an estate. That they inherit. There are no federal inheritance taxes, and only 6 states levy any form of inheritance tax. Given the state-specific nature of inheritance taxes, this subject is beyond the scope of this article. So you probably want to talk to a CPA or a estate planning attorney. They can probably give you more detail on that, on state-specific ones. Estate taxes. These taxes are paid out of the estate itself before anyone inherits from it. The estate tax has a minimum threshold. In 2021, that threshold was $11.7 million. As with other tax brackets, the government only taxes the amount which exceeds this minimum threshold, meaning that if your estate is worth $11,700,001, the government will levy taxes on that $1. The remainder passes tax-free. Capital gains taxes. These are taxes paid on appreciation of any assets that an heir inherits through an estate. They're only levied when you sell the asset for gain, not when you inherit it. Cash that you inherit is taxed through either inheritance taxes, when applicable, or through estate taxes. In the case of inheritance taxes, it is your responsibility to file and pay this tax. In the case of an estate tax, the IRS taxes the estate directly. As a result, it's uncommon for an heir to owe any taxes, including income tax on inherited cash. The IRS does not automatically tax other forms of property that you might inherit. This means if you inherit property, stocks, or any other form of asset, you will generally not owe taxes when you inherit. For example, if you inherit your grandparents' house, the IRS will not tax you on the value of the property when you receive it. There are exceptions to this rule in certain specific circumstances. Most often, these exceptions apply to assets that generate revenue, such as income investments, retirement accounts, or ongoing businesses. You will, however, owe capital gains if you choose to sell this property. When you inherit a property, whether real estate, securities, or almost anything else, the IRS applies what's known as a stepped-up basis to that asset. This means that for tax purposes, the base price of the asset is reset to its value on the day that you inherited it. If you inherit property and then immediately sell it, you would owe no taxes on those assets. Capital gains taxes are paid when you sell an asset. They are levied only on the profits, if any, that you make from the sale. For example, say you buy a stock for $10. Later, you sell the same stock for $50. You owe capital gains on $40 that you made from the transaction. The two prices are involved in establishing capital gains tax. The sale price, how much you sold the asset for, and the original cost basis, how much you bought it for. In our example, the sale price of the stock is $50. The original cost basis is $10, and you're taxed on the difference again, which brings us to $40 in taxable income. Now consider this scenario that your grandparents bought their house years ago for $100,000. Today, it is increased in value and is worth $500,000. If they were to sell the house, they would pay capital gains taxes on $400,000. Sale price $500 minus the original cost $100,000. You're left over with $400. Instead, however, they die and pass the house down to you. At the moment you inherit, the IRS will consider the original house's will consider the house's original cost basis stepped up to the current market value. This means that if you immediately sell it, you will pay no capital gains taxes. Sale price $500,000 minus stepped up original cost basis $500,000 equals 0 taxable income. On the other hand, say you hold on to the house for a year, during which time the price of the house goes down by $100,000. If you sell it, you would owe capital gains taxes only on $100,000, or it goes up by $100,000. Sale price $600,000 minus the original stepped up basis of $500. That's $100,000 taxable capital gains. The stepped up cost basis means that it's relatively rare for heirs to pay significant taxes on any amount of inheritance. So, things most people probably are aware of, but I figured I'd share it for those who might inherit some property that you would have to potentially pay taxes on if you were to liquidate it or sell it at some point in the future. So just some food for thought. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And hope everyone has a fantastical evening. The Astros are still playing right now. I think they're winning. I've been able to pay attention as I'm talking to you and trying to keep an eye on the game at the same time. So, like I said, hope everyone has a great night, and I'll be back tomorrow. Bye-bye.